Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Welcome to the Worry-Free Retirement, and with us in the studio, we have Mr. Craig Davis, who is our 401k rollover specialist at Tony Walker Financial, as well as our fellow fiduciary in the Louisville office, Mr. Wes Walker. We had talked on a previous episode, gentlemen, with all the layoffs going on, people just deciding to retire, company closings, these 401ks, which for many of our clients, our saver clients, they're a large portion of their assets, and sometimes it's all of their assets other than their home. And it's a huge decision for them. I mean, let's put ourselves in their shoes. They've been in a company 30 years. They got this 401k. They trust the custodian because they've obviously invested in it. It's done well. You know, they've had it 30 years in the market or whatever. And now comes the time of, do we leave it there or do we roll it over? Now, Craig, being the rollover specialist here, you made an interesting observation. If somebody says, well, you know what, I know I'm getting ready to retire, been laid off, I think I'm just going to leave the 401k plan there. What harm would that be just to leave it there? What are some issues that come up, Craig?
A couple of challenges I see. If you leave it there, there are times where the custodian will change. And so maybe it goes from Fidelity to Empower. You get some Empower mail at your house. You think, I don't have an Empower account. You just tear it up and throw it away. It's easy for those kinds of accounts. You just lose track. And many of these companies set a 3-year window. So they say if we have not had active contact with you in 3 years, we consider the account lost, and it will move over into Kentucky or Indiana's unclaimed assets. So you can be receiving the statements. This happened to a family member of mine, receiving the statements every year. You look at them, you note them, you file those away. But because you haven't actually logged on or called in 3 years, they consider that account abandoned, and they move it to unclaimed property.
Man, I just learned something today.
I didn't know that either. Yeah, that's
me and
wild.
Wes were like, I guess that's two Walkers for you. Here we are over here. We didn't even know what was going on. Well, and again, that's why we've got you as a specialist. Anything else that you might see with all of these rollover calls you do, or that would say, here's another reason you may not want to leave this with the custodian and get it over to somebody like us, who's an independent planning firm that can watch over a little more closely.
Especially if you're in a little smaller, right? You're in an employer maybe that's 100, 200 people. If that company is acquired, all of that's going to be shifting. And that information, again, it's not always transferred exactly like it should be. And so they might get your name and account number, all the information, but no address or no email. And they never have the ability to reach out. So you're calling around from Empower to Fidelity to John Hancock, and you're trying to track down one of these. I get those all the time. You'll send people along and say, he's got a 401k or an old pension. He's trying to track down these benefits, and we make call after call looking for these accounts.
And Wes, do you run into that? I just thought of that too. So let's say these accounts do move over to different custodians. Maybe the employee says, I know it moved, but I don't care, whatever. Do they also change the types of investments? That happens, doesn't it? The new custodian may not mirror or offer the same investments. And what happens in that case if they don't?
Yeah, to my understanding, I mean, I think that the employee, will sign up for a certain kind of investment mix. They might say, I want a moderate growth allocation, or I want a balanced equity allocation. When that moves from one custodian to another, and when we talk about custodians, we're just talking about who's holding the assets. Inside that 401k plan, the different investments that they offer may be geared toward a similar level of risk that the employee has indicated, like I want a balanced portfolio. But the investments themselves, because they're through a new custodian now, might have completely changed, and they could, in theory, be different from what they had prior.
And you mentioned either this episode or another one, these target funds. And we don't want to trash target funds, but interesting, something came up the other day. Somebody was thinking about rolling their 401k over, and they were frustrated. What they were frustrated about is they had moved the 401k with the same custodian to an IRA, but all of a sudden the representative from the custodian called and wanted to move 100% of their money into a target fund. And he's like, why would I do that? So any thoughts on why they might encourage these target funds?
Well, target date funds have a place in the world of retirement. All a target date fund is that you set a date in the future that you think you will retire. So let's say, for instance, you select a 2040 target date fund. Of course, we're in 2025 now, so that means you're thinking of retiring in 15 years. And as that 15 years went by, you would slowly go from more in stocks to less in stocks and more into bonds, which are considered safer. Not necessarily a bad thing, but why an employee-sponsored plan or employer-sponsored plan might recommend them. They could charge higher expenses. They might have higher expense ratios relative to the other funds, which can get a financial company more money. In any time that you're dealing with any financial company, there's always going to be some conflict of interest, and that might be why that fund in particular was pushed on that person.
And my concern is too, Wes, you being in the investment area, that it appears a lot of times based on the person's age, maybe the rep who has good intentions but is recommending these target funds because it is so clear-cut. Well, you're 15 away. Well, maybe those people don't want any risk, right? I mean, that happens. We have people come in who are in their 50s. You would assume they're fine with the stock market, and they don't want any risk whatsoever. So to just slide them into a 2040 fund probably could be a bad move for them.
If you went through the typical financial planning process of, what the internet would tell you to do, a 50-year-old person might still be 70 or 80% in stocks at their age, but it really depends on their financial personality. If you haven't taken the time to get to know the person prior to making an investment recommendation, you might not know that person really is not comfortable with any amount in the stock market, which sometimes we may facilitate that. We might not have anything in stocks if that's an ability that they have relative to their net worth. So I think, when you're working with a custodian, they, might not know everything they need to know about you before making an investment recommendation, which is why I think it's a good idea to get a retirement planner in your corner.
And I was going to say that, kind of batten down the hatchets here. So, Wes, somebody is out there, they're retired. They're over the age of 59 and a half, been laid off. They know their company's getting ready to close. In other words, that 401k is eligible to be rolled over to an independent firm like Tony Walker Financial. What are they going to get from us that they're not going to get if they leave it at the custodian?
The big one is the retirement income plan. So they're going to be able to see when and from which accounts they'll withdraw from with this newfound change where they're no longer working. They'll be able to see where they're going to take money out of and what might make the most sense tax-wise and investment planning-wise. One thing just for fun that I might note is we might even recommend leaving some money in the plan, and if they're prior to 59 and a half, just for the reason that if it's still with an employer plan, a lot of times you might be able to get some money out of there prior to 59 and a half because it is employer sponsored. So that's why I think all these rules that the average person might not know about, it's important for them to get someone like us in their corner so that they can figure out what the best way to go about doing things would be.
Yeah, Tony, one thing I would want to interject in that as well, one of the big reasons for dealing with us as opposed to a big firm, there were multiple times this week I called with a client and I spent over an hour on hold. And at the end, the client said, yep, that's what it's always like. When you call us, you're going to get somebody. You're going to get an answer. You don't have to know everybody in the firm's name. We're going to be able to take care of you with one phone call.
Oh, excellent point, Craig. Well, gentlemen, we're out of time. Thank you so much for your time. We'll be right back.
With the stock market at all-time highs, our nation's debt through the roof, and inflation racing out of control, now may be the best time to consider safeguarding your money. That's why I'm offering to review your 401k and other retirement accounts to be sure that you aren't taking too much risk and you're not going to run out of money. To set up your free meeting with me, simply log on to TonyWalkerFinancial.com and let's get started. Wondering how annuity peddlers can offer bonuses of up to 15 or even 20% on your money? Well, as the old saying goes, if it sounds too good to be true, there's always a catch. Here's my thoughts. Don't get stuck in the wrong annuity. Get a free second opinion from one of the leading writers of annuities in the country, Tony Walker Financial. To get started, simply log on to TonyWalkerFinancial.com or call 877-499-WALK.
Welcome back to the Worry-Free Retirement, and we're talking about this whole notion of being able to spend and enjoy our money, which is the whole live well, die broke philosophy, and the problem that many savers have, and that is not having what I would call a spending plan and an understanding realistically of how money is spent over time. I'm going to get into the three halves of life in just a second. But this is the problem. This is a 35-page report that a prospective client came in with their advisor and wanted me to look at. And immediately I've seen these things. Folks, I used to do this kind of stuff, this financial planning stuff that makes all these wild assumptions. And what's interesting about this, again, this is really not a spending plan. Here's one thing on page 8 of 35. There's 35 pages here of just numbers and spreadsheets. I mean, this person looked at me and said, I have no idea what I'm even looking at. But notice it says if we went back to the 2008, this portfolio they're recommending would have only lost 20% and the account would have gone down $128,000. Now, most savers in retirement, that is unacceptable. Then you go over to the probability of success. I love this page. It says based on the portfolio and their simulations, and we do some simulations too where you go back and test things, that means nothing. But even with their simulations, there's only an 84% chance of success. In other words, potentially in the year 2035, this plan could run out of money. So to me, this doesn't sound like a plan at all. What we're trying to do is achieve 100% success, and that starts with having an understanding of what retirement looks like. Folks, we're not trying to grow money and grow money and grow money to compound inflation and all that. That's not how retirement works at all. And again, as someone who has met in person with over 20,000 people, we have nearly 4,000 clients, most of whom are retired. We have the experience and know how to understand how this spending plan is going to play out. And I created this some 20 years ago. It's called the 3 halves of life. And you may have seen this countless times. But I feel like I need to keep going over this because, again, people come in with these types of plans that are trying to project all of these huge amounts of money in the future, and it makes no sense whatsoever, especially if you have what's called a qualified account, a 401k or an IRA. I mean, think about this, folks. One day you're going to pass away, and if you've got this huge amount of money stockpiled, it's going to have something buried inside it that I call the tax tumor. And that tax tumor is going to be passed off to your kids, and they're going to have to take that money out within 10 years, and this could be a disaster for them. So what we want to do is we want to try to spend down those assets without the fear of one day running out. So again, very quickly, this is called the first half of life. If you're roughly under the age of 50, for the most part, I had someone come in that was 45. They're a prospect for what we do because they're wanting to retire very early and they've got a lot of money. But if you're under 50, the first half is what I call the accumulation phase. Generally, that's not our prospect. Our prospective clients are people who have reached halftime, and generally that's over the age of 50, or who are what's called in the second half of life, and that's generally those over age 70. So the reason we are very good at what we do is we understand that in halftime, that's why the account's going up in value, that's where you're going to start spending the most money. So we actually are going to start spending principal and interest. We break this up into 5-year increments. We did this on purpose when I designed this software. I want to give people a visual of what's going to happen over their lifetime and what is more realistic. And what's more realistic is as people get into the second half of life, they start spending less and less money. And this may be you right now. You may have a faulty notion of how much money you really need to make it in retirement. In fact, here's an interesting article right here. It's talking about needing $1 million. That's what everybody thinks they need is $1 million. And while certainly $1 million will help in retirement, folks, there's many people I work with out there that have $250,000, $350,000 who just don't spend a lot of money and can comfortably retire on that amount of money. Again, it just depends on how much your lifestyle requires in retirement. So the best thing you can do is meet with somebody who is experienced in the field of retirement planning like Tony Walker Financial. We have the experience, we have the know-how. I have other members on this team in place, so should something happen to Tony Walker, I have 3 highly trained salaried fiduciaries who can take over and run the operation and continue to maintain your income plan in retirement. So that's you. If you're retired, nearing retirement, maybe you're approaching the age of 59 and a half and you want to get that 401k over to an advisor locally that can manage it for you, we need to talk. So to set up a time to visit with me briefly by phone, just log on to TonyWalkerFinancial.com, TonyWalkerFinancial.com. Let's set up that free phone call, and if it warrants, we then are going to meet in person. That's right, I'll be meeting with you to lay out your personalized game plan at no cost or obligation to you. Internet not your thing? No worries, just call us anytime at 877-499-9255.
When it comes to your will, you don't want to miss this step. Let's check in with Tony as he's joined by Heather Hughes, Wes Walker, and Trey Juergens.
It's very important to double-check your beneficiaries, maybe on an annual basis, to make sure there aren't any changes that you need. Because if something happens to you and you've got an ex-spouse on a beneficiary form, it's going to them, whether you like it or not. So that's the thing. I mean, if something happens to you, whatever's on the beneficiary is going to trump anything else you have. Will, trust, it doesn't matter.
Yeah, Wes, I think Trey said that the other day. There are times when your will does not matter. What is he referring to there?
Well, we're not estate planning attorneys, but we can certainly review trust will documents, help people understand what happens at their death. You could have the fanciest trust drawn up in the world, spend all kinds of legal fees and, get it dotted, every I dotted, every T crossed. But if most of your money is in retirement accounts or designated beneficiary accounts, those beneficiary designations will trump the will and will trump the trust that you formed. So that's very important to just review the beneficiary designations on those accounts in addition to your normal estate planning like wills and trusts.
I know sometimes, Trey, people want us to talk to their attorneys. We're happy to do that. I mean, I used to do a lot of estate planning and all that kind of thing, but what we always try to provide the attorney, I think, rather than trying to give them advice on the legal advice side, is make sure the attorney fully understands how these assets are held. And I've seen some of these attorneys very appreciative of these game plans because a lot of times they're not sure. They're just trying to draft the trusts and all that. But to Wes's point, I mean, if somebody has, let's say, all of their assets are in an IRA and maybe they've got a home over here, maybe they don't need as fancy a trust as they thought they did.
Yeah, we had a client recently. We delivered that final binder, went over all the contracts, all the Schwab accounts, confirmed how the accounts were invested, confirmed beneficiaries on every account. I think there were 6 different accounts. They went and shared that with their attorney, who they had already done some trust work on, and the attorney even told them, oh, wow, this is pretty impressive stuff. The way that they had everything drawn up, nothing had to really go through probate. The attorney agreed none of the assets with us had to be put in the trust. So everything was very clean, everything was confirmed and organized, and both of them felt really good about it.
This is Heather Hughes. I'm one of the full-time fiduciaries here at Tony Walker Financial. One of my main roles is to research and evaluate different annuities we offer to clients. One of our common complaints we hear from savers is that they don't understand what annuity they've purchased from another agent or advisor and how their money may be tied up. With that said, we'd like to educate clients on the 3 types of annuities for planning purposes. First is the short-term accumulation annuity. That typically has a surrender period of less than 5 years. A surrender period is a time frame during which there are restrictions on how much money you can withdraw from your annuity given any year. These annuities often offer fixed interest rates for a guaranteed period. Long-term accumulation annuities typically have a surrender period between 6 and 10 years. These are geared toward long-term potential growth. And finally, income annuities, or what we like to call mailbox money, provide lifetime income for you and or your spouse for as long as you live. We advise clients on what might be the best choice for annuities based on their individual circumstances and how it would best fit with their income plan. If you have questions before you purchase an annuity from another advisor, please feel free to email me at heather@TonyWalkerFinancial.com.
Getting ready to roll over your 401k to an advisor you barely know? Are they just going to invest your money, or do they actually have experience in retirement planning? Well, here's my advice. Don't leave your retirement to chance. Get a written game plan from an experienced retirement planning firm that has created more than 5,000 written game plans. To get started, simply log on to TonyWalkerFinancial.com and click on that Let's Get Started button. When my favorite nephew recently sent me this clip of a television show host talking about investments, interviewing a guy from Wall Street talking about the plight of savers who are now earning next to nothing on their savings, I had to laugh because for the first time in my life, I actually heard someone from the investment world acknowledge that there are people out there who for years I've called savers, and that these savers don't think and act like these 2 folks who represent the investment world. In fact, after witnessing the tragic events of 9/11 and the financial fallout of 3 straight years of stock market losses, that there are basically only 2 different types of financial personalities that people fall into, and those are savers and investors. Now, actually, there's a third financial personality, and I call that the speculator, but this one is too rare to mention, so we'll just focus on savers and investors. Well, today, I'm going to be pulling the curtain back on why savers are being left in the cold by banks and Wall Street and how you can get more control over your money. Okay, I've got a little riddle for you. What do two guys from the investment world rambling about the woes of savers who, as of the date of this recording, cannot find good interest rates at the bank, have to do with savers being worry-free in retirement? The answer? Absolutely nothing. That's because the folks on Wall Street and the big banks are investors. They are not savers. Here's the problem savers face today. With banks paying next to nothing in interest, our nation's debt going through the roof, and the stock market at all-time highs, is it any wonder that a little man in a sweater vest, whose humble opinion is this, says that probably what's the problem is the fox is guarding the hen house. In other words, savers are trying to live in a world guided by investors. Investors who know a whole lot more about money and how to make money on other people's money than do savers. You know, gone are the simpler times of running down to the local bank and earning 6% on a secure CD. Today, we have to ask, what in the world are savers supposed to do when really they've only got two options in retirement, neither of which are very good? First, they can keep their money safe at the bank and earn a paltry 1%, or hopes to earn 1% anyway. Or second, they can leave the safety and security of their local bank and head on over to the bank's kissing cousins and trust the fat cats over on Wall Street to earn a better return. None of this is good news for savers who simply want to enjoy the fruits of their labor without the fear of one day running out. Well, guess what? Today, I've got great news because I'm going to show you how you can get a totally different way and approach to managing your money. One that has over time proved to be a wonderful world for savers looking for other options to save and invest their money. So when I return, I'm going to go first to educating you about an educational program I created years ago, and then how savers are better able to determine which investments are right for them. You stay tuned. I'm Tony Walker. I'll be right back.
Now remember, folks, when you roll over your 401k with us, you get a 15% bonus. How's that sound?
That sounds too good to be true.
Come on, don't you trust me?
What are your fees?
That is a great question, and we'll get to that after we roll over the 401k.
I think we need to get a second opinion.
Don't leave your retirement to chance. Get a second opinion from TonyWalkerFinancial.com.
Of all the breakthrough concepts I've observed and followed up on, the one I noticed and created, which quite frankly, I felt would have changed the way we all view money, is something I call the 3 personalities of money. Now, not only did I write a book about it, but I also spent a great deal of time and money studying what makes people tick and how and why they invest in the products that they do. It was and still is my humble opinion, an ingenious way of helping people understand which investments are right for their personality. In fact, right now, you can take this free 5-minute test by logging on to 3personalities.com. Again, it's absolutely free, takes about 5 minutes, and it also appears basically in the investment world. So not only have for years I've been talking about this idea of using psychology to think through things, this particular article, they're out there, they're rampant right now, how do you determine the amount of risk you want to take in your investments? Most of this stuff that you're seeing out on the internet is for investors. It is not designed for people like you and me, people who are more concerned about the return of our money than on it. What are a lot of the products out there that anybody can choose from? Now, keep in mind, there's all kinds of things you can invest in, folks. I tried to pick the things that seem to be the most popular, and let's start off with bank instruments. This would be like CDs, money market, and savings. So the question is, do investors love these products? And the answer is, obviously, no. That's not something an investor would be interested in. What about savers? Absolutely. Now look at cryptocurrency like Bitcoin. Is this something an investor would like? Well, of course. Should savers probably spend a lot of time investing in Bitcoin? Probably not. What about dividend participating whole life? One of my favorites. I got a ton of this stuff. Well, if you listen to a lot of financial entertainers and investors, they're not going to invest in dividend participating whole life. But for savers, it can be a wonderful planning tool. What about fixed annuities? Since 9/11, I've written as far as many annuities as anybody in the country. I love fixed annuities. But fixed annuities are not designed for investors, folks. If you're an investor, you're probably not going to want a fixed interest annuity or a fixed indexed annuity. They're designed for savers. What about gold, silver, precious metal? Well, in this case, investors, but sometimes even savers, might dabble in that, but that is a very speculative investment. Government bonds? Investors aren't going to fool with government bonds. Savers love government bonds for the safety and security they provide. High yield bonds. Now we're getting into more risk. Investors love those. Savers, maybe a little more questionable. What about raw land? Yes, I said it, raw land, because as we record this show, there's a lot of investors out there purchasing a lot of land, and actually some savers have a lot of that land that they might want to sell. A lot of people right now that I meet are being approached by investors. People have large parcels of land or farmland, and they can't believe how much this stuff is worth, but it's a reality. Variable annuities. Again, variable annuities are something we don't do. That's in the stock market, so that would fall over to investors. Savers should probably steer clear of variable annuities. Now, the last one I left for last on purpose, that'd be stocks, mutual funds, growth funds, ETFs. Investors, yes. Now, why do I have a question mark there? You say, Tony Walker, you're all about savers, but why would someone want to invest in the stock market? Well, because sometimes people are okay with a little bit of risk. So to tell you more about our process and how we help people determine their risk tolerance, I have in-house here Wes Walker, a fiduciary in the Louisville office.
Good morning, Tony. Thanks for having me.
Just describe our strategies and the difference in those strategies and why we might select one strategy over another for our particular saver clients.
Sure. So we have 4 strategies that we manage in-house. Now, we don't always use these strategies. Someone might bring over what we call in-kind securities, meaning the stocks and bonds that they had at a prior institution. We might hold those if it's part of the game plan. But a lot of times, what we'll do is place money into one of these 4 strategies. They are as follows: the enhanced yield liquidity strategy, the conservative, the moderate, and the growth strategy. Now, they have 0% equities in the enhanced yield liquidity strategy, and 30, 60, and 90% in the stock market in conservative, moderate, and growth respectively. So the reason we have these different buckets is that for different pots of money, people may have different goals. So just as an example, let's say someone has a Roth IRA that they're okay leaving alone for a while and are okay having a lot of volatility in the account, but they want to grow it into a larger sum. They've got a long time horizon and a good high risk tolerance for that Roth money. We might put them in the growth strategy. Whereas someone with an IRA that they're needing near-term distributions from, they're needing to take money out soon, we might put them in the conservative strategy with a small amount of stock market exposure. Or if they're a true saver, they might go into the enhanced yield liquidity strategy with no stock market exposure whatsoever. So it's all a function of someone's risk tolerance and their time horizon.
I think the beauty of our process, let's say someone does select moderate, and for some reason they get a little queasy over the market, it's got 60% equities. Is there any cost to move to different strategies if they choose to move to another strategy?
There's no cost, but what we would always say is that it's always easier to move up in risk than it is to move down in risk. So if somebody's in moderate and they're feeling queasy, and they maybe have lost some money. Now, if they sell those securities, there's a chance they can make that loss permanent. That would be the only inherent cost. But from our end, there is no extra fee or transaction cost to switch strategies.
Well, how about you? Are you at a point in life where you just feel like you need to find somebody you feel will work in your best interest? An advisor who is truly there to do their best to find investments that fit your true financial personality instead of just tossing your money over to the next thing that comes along? Let's just talk. You can either pick up the phone, even if it's on the weekend, you can call in and you will reach a live answering service who will follow up with you. And then in the first thing Monday morning, our offices at Tony Walker Financial will call you back to arrange either a 10-minute free fiduciary phone call or we can meet in person. Or if you'd like, you can simply go to our website at TonyWalkerFinancial.com and you're going to click on the Let's Get Started button. So again, you can either set up a free fiduciary phone call or if it warrants, you can schedule a no obligation appointment with me personally at either our Bowling Green, Louisville, or Lexington, Kentucky offices. So what are you waiting for? Log on to the internet, TonyWalkerFinancial.com, or call 877-499-9255. Well, tune in next week for the Worry-Free Retirement. Between now and then, if all else fails, you be worry-free. Make it a good one.